Hello, welcome back, guys. One of our subscribers actually asked about a company that he is interested in. And I thought this is an interesting example of a company that has a lot of similarities with other companies that a lot of people would be interested in. And so I wanted to make a video about it. As you'll see here, Andy actually spotted my Greek accent. Yeah, I'm pretty Greek. And they're interested in ATIP. Now, what they are saying here is that they live in the city they are based out of and don't know much about the company's financials. Everyone he has spoken to says they are wonderful to work for, their places are clean and busy. And it's a thing that you see often with people, like they are hearing from colleagues or from friends that this company is nice, or that maybe they have been there and everything is looking clean and tidy. But is it a good investment? So that's a completely different question, to which we're going to attempt to answer in this video. And of course, even if you are not interested in this specific one, stay tuned. There's going to be some very, very interesting things that we're going to be talking about here. Okay, so as you'll see here, ATI Physical is a relatively new company. You will see here a very, very interesting thing. I have taken the chart back to 5 years, and you will see it starts over here. And it starts at $10. And when this happens, it is very likely that we are talking about a SPAC. Now, I have talked about SPACs in previous videos, about DWAC or DraftKings, very well-known SPACs. You can take a look at these videos if you're interested in more details, but we will talk about what a SPAC is and how this affects this company. And so you can see that here it starts from $10. It went up to at some point like $12 and then went down precipitously, reaching 70 bucks, 70 cents almost, since it's 1 year high of almost 450 over here. And it's down like more than 95, 97% from its all-time high, I suppose, over here. Now, this doesn't mean that it is not a buy, but this is also doesn't mean that it is a buy. A lot of people are looking at this price and are like, okay, how much less can it go? How much down can it go from here? And the answer is a lot. Like, it doesn't look like it because it's been to 12 bucks and now it's like 70 cents. And you are thinking, where can it go? Like 50 cents, 40 cents? But there is a very, very important thing here that some people may not be aware of, and that is splits. You may have heard about splits in regards to, let's say, Google or Amazon, and these were normal splits. These were splits where you have like 20 stocks and they merge, they become one stock, one share, and then you get like a divided price, so the price goes down. But there is also the different thing, the thing that is pretty much the opposite of a split, which is called a reverse split. So what happens in that case is if you have 20 shares of this, then these 20 shares could become one share. And now all of a sudden you multiply that by 20 and you have a new price which is higher. And as you can understand, the stock price could keep dropping from there. And so when that happens, this pretty much allows the stock to go down even more and more and more. And the thing is, when we are looking at the 70 cents stock, this is very, very likely to actually happen, because stocks that are listed in the stock market have to be at least $1. And if that doesn't happen for a while, then they have to be moved to the OTC market. And so you could very, very likely see a reverse split here so that it actually goes above the $1 range. Or it could be moved to the OTC market, as long as it doesn't reach $1 anytime soon. And this seems to be like it's newly at this level. So it's not, it hasn't been at this level of less than $1 for a while now. So this is a concern that I would have, a primary concern. But bear that in mind, this can happen, and it happens with a lot of companies. Now, a thing that I like about this company is operating in the healthcare sector. So as we're entering a recessionary environment, this is a good sector to own, generally speaking, because it's non-cyclical. I have talked about the seasonality of sectors, pretty much, I should say, or I would say the cyclical nature, to put it in a more correct term. Now, when we're talking about cyclical industries, cyclical sectors, we're talking about products or services that are affected by cycles, by economic cycles. And so things of that sort could be, for example, oil. Remember where oil was like 2 years ago. It is really, really affected by the economic cycle, for example. Now, the point is with the healthcare sector is that people need their medicine. And so as long as the company actually has some nice medicine that people need, they will always be needing that medicine. So it would be difficult for them to cut down on this expense. They can cut down on cars, they can cut down on all other things, electronics, but not really on healthcare. So this is why it's a good sector to own when we're entering a recessionary phase in an economy. And I wanted to take the opportunity of this video to kind of show you this thing here, the elasticity of demand, which is a little bit economics based, but it's important to understand. And this has the example of insulin here, which is considered perfectly inelastic pretty much product. It may not be perfectly inelastic in every market pretty much, but it's close to that. And the reason for that is that people, if they don't get their insulin, they will die. And this, generally speaking, means that they are willing to pay as much as possible. Now, forget about the social aspect or the governmental aspect. When we're talking about the economy and economics, economics is actually a science that is looking at things from the perspective of like more is always better. And so you can, of course, add all these issues, the governmental issues, for example, or the societal issues later. But for now, we're examining pretty much the supply and demand power over the economy without actually considering the actual people. That's how economics start, because you need to see what is the demand and supply regardless of all of the other aspects of the economy, or I should say the social aspects, for example, or the government pretty much interventions. So what you will see here is that for a specific quantity of insulin, the demand normally curve over here is basically a line, which means that people are actually willing to pay any price, as you'll see over here, for the same amount of insulin. This means that this product is perfectly inelastic, so basically you can charge as much as you want for it. The opposite thing would be, for example, wheat over here, where, as you'll see here, it is perfectly elastic, which means that people are actually not willing to pay more than they have to, because it's basically the same thing here, and pretty much a tiny increase would drive the quantity demanded to zero, as you'll see here. And you can look at this chart over here, and you will see that if somebody tried to be at this level, like charge more for the same quantity, they would fail because they are not inside pretty much the line over here, the demand curve, as we say, the demand line in this situation. So this is important to understand because it tells you what are the forces inside the economy and how all of these products pretty much behave. There is a curve for demand, there's a curve of supply, these curves meet at some point, and this is basically sort of like the perfect price. And it has to do with the budget and all sorts of things for the economy, of course. It's much more complicated, but it's a nice thing to know. Now, let's move on to the actual company here. I wanted to take a look at this article here, just to tell you a few things about a SPAC. As you'll see, this company is a SPAC, and ATI Physical is a SPAC. And you will see here that a SPAC is basically a blank check company. It's a company that completes an initial public offering. As you see, competes for an initial public offering here. It is not really a public company, but becomes public, sort of like using a shell, as you'll see here. After becoming a public company, the SPAC then acquires or usually merges with an existing private company. In this case, that would be this company that we're talking about. Before completing a merger or acquisition, many SPACs provide no indication to investors about the type of company they plan to merge with or buy. Now, you can see all of the details here on what happens, and again, you can watch my other videos where I describe them in more detail. That's not actually the point of this video. But it's important, this paragraph is important over here, and I wanted to mention a word of caution over here. You will see that for IPOs, companies are permitted to share past financial results and talk broadly about the markets in which they operate, but they are prohibited from projecting future financial performance. In contrast, the company going public via a SPAC deal is allowed to present detailed revenue and profit projections that are forward-looking by 5 years or more. For young, pre-revenue companies that might prefer for investors to focus on their potential instead of their unimpressive results so far, that regulatory distinction confers a significant benefit. Now, the thing is, the big problem here, and the cautionary tale, as you'll see here, for example, with the case of Vector IQ and Nikola, shares rapidly increased after when the merger happened, for example, and the stock price has since returned to pretty much almost its starting point. And in this case, in the SPAC that we're talking about, the healthcare one, It's actually much lower than what it started with. But the thing is, this kind of shell company pretty much bypasses all the normal, I should say, procedures that the company would have to go through when we're talking about a normal IPO. It's sort of like a way to pretty much expedite the process. And again, I have made a video in which I'm discussing the finer details if you're interested. But what's important to note here is that it's a little bit of a, I should say, a riskier investment because of that, because it was actually a private business that hasn't gone through all this, all what is required to become an IPO from the ground, pretty much. So bear that in mind. And as you'll see here, ATI lost money in Q2, and even ATI isn't sure how much it lost, and it got destroyed back in July 26, 2021, as you'll see here, falling 36% over here. Analysts had forecast that the recent SPAC IPO, is what I told you earlier, would report in excess of 175 million in revenue. They did 164 and all of that pretty much, and basically started going down and down. Now, that doesn't necessarily mean it's a bad thing. I kind of wanted to talk you through what the company is about, what they have been doing, just so that you can understand the structure that they are having. It's not like your typical IPO. But what are they doing in terms of the financials here? Now, you will see that the PE ratio is negative, and the price to free cash flow is also negative. This means that the company is losing money, pretty much, to put it simply. And they have been losing more money in the past. Now they're losing a little bit less, but still losing money. As you'll see here, it's a bit of a bad story. Actually, price to free cash flow was a little bit better. Outstanding shares, they haven't been issuing too many, but overall you will see that their key metrics are all negative. Pretty much everything goes down. Net income, free cash flow, total equity. This is not a nice picture to see. This is not what you are looking for in a company. And if you are looking to buy a company that is losing money, then you have to be super careful, and you have to be a little bit cautious about the risk. You have to be willing to get this extra risk because the company is just not making money. And as you'll see here, another red signal is the fact that the company has a pretty high debt to equity ratio, meaning that it has a lot of debt compared to the equity that the company has, about 1.6 over here, and it seems to be climbing in the recent quarters even more. So, what is some finer details about this company? We can take a look in our tool at the financial statements of the company, starting from the income statement, and see what's going on over there. Apologies, my internet connection is kind of doing its thing. Alright, so you will see here that the company started with a revenue that was actually higher than what it is right now, and that is a bad sign. Now, they did a little bit better last year, but overall it has been going down, and this is not something that you like to see. And net income is also going down in negative territory and firmly into negative territory. And of course, these are generally speaking pretty bad signs for companies. We want them to keep increasing, especially if they are actually new companies that are even losing money. We want them to at least keep increasing the revenue, and the company doesn't seem to be doing that. In terms of the total equity, it is also going down, meaning that they are losing a lot of assets, or I should say they are losing a lot of equity. Actually, they are losing a lot of assets. It's mostly the assets that are going down. It's not the liabilities. And in terms of the cash flow over here, the cash flow that the company generates, take a look at what we talked about earlier, the fact that net income is going down. The company is losing more and more money here, and of course this translates to operating cash flow that is negative as well, and takes it down to negative free cash flow too. The company is losing money, and when that happens, the company will have to finance themselves. And this is exactly what you see happening. You see that here, 63 million in debt, extra debt over here, then 204 almost million in debt. That's quite significant debt concerning the fact that the company is rather small, right? Because remember, the company is not really making money, and it's like a $2 billion, I believe it's like a $2 billion market cap company. Actually, no, it's $140 million market cap company. So it's a very small company. At some point, I'm pretty sure it used to be a $1 billion company because the price was much higher, significantly higher, more than 10 times. So, if I go back here in the cash flow statement, you will see what we talked about, and the fact that the company is investing a little bit over here, not much going on, but we're just playing with just a few million over here, and typically the company seems to be losing money. At least this is the free cash flow, but remember, this originates from negative net income over here, and it's only after some adjustments pretty much that the company is able to make at least close to zero in terms of free cash flow, or some positive free cash flow. So that's not a good sign. That's not a good picture. Now, there is a thing after the company has been going down that much, maybe, just maybe, we can potentially buy it and hope it's going to be doing a little bit better in the future, and maybe just play it for a company that we can buy that for very, very cheap potentially, and just give it a little bit of a sort of like a lottery ticket side in our investing portfolio. It's not a horrible idea to have maybe one or two companies that consist of a very, very low percentage of your portfolio, but you definitely don't want to overdo that, to overdo it with these companies or buy too much of them. Because again, you can see here that the revenue growth has been, generally speaking, negative. So the company hasn't been growing, and that's a pretty big issue over here. That's the worst thing that you want to be seeing out of these companies, the fact that they won't be growing. In some situations, especially in the good old days where everybody was buying everything, when the markets were super bullish, investors would actually pile up on these companies that were increasing their revenues. But when they are not increasing the revenues, what is there to show? If they're losing money every year, what is to see here is the problem. Now, if we just assume that the company will continue growing at what they grew last year at, let's just say close to 6%, let's just go 3, 5, and 7. Let's just say that the company will be growing 3, 5, and 7. That's going to be our projections, either 3, 5, or 7% every year for the next 5 years. Now, the net income margins, remember, the company has been losing money. It's only 1 year when they just made a little bit over here, but overall it has been negative. We're going to assume that the company will go back to marginal profitability. Let's just say 1, 3, and 5% over here, with 3 and 5% obviously being much more aggressive than what the company has seen in the past. The free cash flow margin that the company generates, of course, we cannot have something here because it's starting from negative territory. The company has been losing money overall. So we're going to go with something that is relatively normal with most companies, 80, 90, and 100. And an annual return of 13% is what we typically want to be getting out of companies, at least 30%. This is a case where even 15% could be asked for easily because the company is actually very, very risky over here. And if I hit calculate, let's see what we're getting. Now, if I can calculate, you'll see that this is not looking that horrible over here, right? Our low price is sitting at 33 cents, medium at 1.19, high at 2.32, and this is for these projections. But remember, these 33 cents here start with a low projections of 3% revenue growth, 1% net income margin, 80% free cash flow margin, and an annual return of 13%. And the company hasn't been achieving this. Now, it's not super far from achieving it. It could potentially achieve it, but I'm not sure if it's going to be happening for the next 5 years, like every year for the next 5 years. So you can kind of get a sense of what the company is worth today based on these metrics. And again, these are kind of aggressive metrics, but you can use this to understand what it makes sense to pay for this company or what it doesn't make sense to pay for this company. And so as it is right now, what I would have to say about this one is it is a risky proposition. Now, if somebody is looking to invest in this one, they should understand that this can go lower. And actually, this can go significantly lower based on what it is right now and based on what it has been doing financially and based on what the markets are actually doing right now. And so I would be a little bit cautious here. I wouldn't go overboard. Don't pay too much attention on what is actually what the looks of the company are and what people are telling you, because the actual company is much different to the stock, completely different thing. And when you see the financials here, things are not looking that shiny anymore. And you have to factor all these things, what the company has been doing in the past and how it has been basically crumbling. This is an insane drop over here. This is an absolutely insane drop. The company has fallen off a cliff. So you have to bear that in mind. This is not a company that is a non-risky company. When you decide to invest in that, you have to be willing to take up a lot of risk. You could potentially be rewarded handsomely if the company goes back to profitability. But I kind of wanted to touch base and kind of tell you everything that I was thinking and I'm thinking of about this company. Hopefully, it will help you a little bit, Andy. And thank you for suggesting this one. I thought it would be an interesting one to discuss. Do tell me what you think about this one in a comment. If you want to ask anything, feel free to. And thank you for watching. I'll see you in the next video. Bye bye.